Rich Dad, Poor Dad, lesson number 1 is the rich don't work for money because money's fake. In there, my rich dad always said, never say, I can't afford it.
Robert Kiyosaki is a successful businessman, investor, and renowned author. He is best known for his Rich Dad, Poor Dad book, which is the best beginner book that talks about financial literacy, financial independence, saving, and investing. Over the years, Robert has given various rules of money that will help you achieve success. In this video, we will talk about Robert's top 6 rules of money that will help you become wealthy. So stay tuned because we will discuss each of these rules to guide you on your path to financial success. So make sure to watch this video to the end. This is Financial Intellect, where we promote that to be finance savvy, we are your buddy. Now let's get right into the video. Rule number 1. Distinguish asset from a liability. One of Robert's most important rules of money is to know how to distinguish an asset from a liability. Robert simply defines an asset as something that puts money in your pocket, while a liability is something that takes money from your pocket. Robert believes that this is the secret of rich people. They limit their liabilities while focusing on building their assets. This might sound so simple, but this can become complicated when applied to our personal financial goals. For instance, when you buy a house, this takes away money from your pocket in the form of down payment, mortgage, and taxes. This house will not produce any income, hence it becomes a liability. This, however, can become an asset if you live in it for a few years while working on upgrading it to flip it later on. This becomes an asset because you can sell it for a higher price, thereby making a profit, while also saving money from rent, which you would have otherwise incurred if you remained renting. This is what rich people do. They distinguish assets from liabilities, and over their lifetime, they focus on building the assets that produce consistent cash flow instead of incurring more liabilities. Rule number 2. Know the different types of cash flows. Robert believes that there are 4 main categories of how people make money. You can earn money as an employee, self-employed, business owner, or investor. He calls this the cash flow quadrant, and each quadrant has its own rules. For employees, their income is earned from their employers. Here, employees leverage their time for money, which is why it's hard to become wealthy in this category. There are only limited hours in a day, hence income will also be limited. People in this category also have the mindset of prioritizing the safety that a paycheck provides over the potential income that comes with taking risks. The next category is the self-employed or small business owners. Here, people are self-sustained. They still exchange time for a profit and are even more likely to spend more hours compared to the employees. However, the potential for higher earnings in this category is high. This is where many wealthy people started. The next quadrant is the big business category. Here, the business is turned into an asset that produces recurring cash flow. More people are hired into the business and systems are automated to maximize resources. Thus, the entrepreneur is no longer time-bound to the business. It can grow and operate on its own. The business here is therefore a true cash flow asset. The last quadrant is the investor category. This is where people use the money to make more money. Robert explained that in this category, people have control and negotiation power over any investment opportunity. Here, the money is turned or leveraged to create cash-generating assets. This is what builds wealth, and this is what most wealthy people do. Rule number 3. Learn how taxes work. We all know that taxes are one of the biggest expenses for most people. However, some people who are earning more can pay less in taxes. If we go back to Robert's cash flow quadrant, people in each category are taxed differently. An employee has little control over how much he is taxed because it is dependent on his income. For federal taxes, those who make over $518,000 are taxed over 37%, while those who make under $9,875 are in the 10% tax bracket. If we add state taxes, these percentages can still go up. So if you are an employee and you want to lower your taxes, you can defer taxes by putting the money in your retirement account or your medical savings account. On the other hand, the self-employed pay more in taxes compared to ordinary employees. This is because they had to shoulder their entire Medicare and Social Security tax, which in the case of an employee, half are shouldered by their respective employers. Since self-employed individuals act as both the employer and the employee, they shall shoulder the entire contributions on their own. Business owners can avail of tax deductions for business-related expenses. For example, a self-employed individual can treat part of his rent as a business expense and have it deducted from his taxes. And for big companies, apart from tax deductions, they can also get tax incentives because they help provide services that the government cannot provide on its own. Amazon, for example, has a credible tax incentive, and in 2018, it legally paid no federal taxes and got tax rebates instead. This is because Amazon understood how taxes work, and they took advantage of that. So if you want to build wealth tax-free, focus on building equity instead of cash. For example, if you purchased a property for $3 million, sold it for $5 million, and have the money reinvested to buy a bigger property that will generate $1 million income, you will now have a larger asset that produces cash flow. You can also lower your tax bill by claiming extra tax benefits such as mortgage interest, depreciation, and property taxes. Before we move on to the next one, if you're new to the channel, kindly give this video a like, subscribe to the channel, and turn on the notification bell so that you will know when we've posted new videos. Now let's continue to the next money rule. Rule number 4. Use taxes to make money. From the last example, let's call the investor John. John bought a property for only $3 million and sold it for $5 million. Now, instead of cashing in and paying the capital gains tax, John decided to instead reinvest the money to buy more property. He could choose to buy a property that costs $5 million, which will bring around $1 million per year, or he could choose to put down $5 million in a $20 million property, which will bring in $4 million every year. Here, John would only invest $5 million and borrow the remaining $15 million from the bank. Now, Robert does not necessarily view this debt as bad. For him, there are two types of debts: the good debt and the bad debt. Bad debt is the one where you have to pay yourself, while good debt is the one where others will have to pay for you. Rich people use good debts to leverage assets to accelerate wealth building. In the example given, John leveraged the bank's money to own a larger property that creates a bigger cash flow. And the catch? It can be tax-free. Rule number 5. Protect your assets. Some of the mistakes that people make are just focusing on acquiring assets instead of also learning how to protect them. According to Robert, one way that you can protect your assets is by using a business entity. When you start a business, it becomes a sole proprietorship automatically. Here, all of your assets can be subject to a claim regardless of whether you committed a personal financial mistake or a business mistake. So when someone files a suit, they can come after your assets or your business assets. On the other hand, when you start a business with someone else and it has no formal entity, a general partnership was formed. In this case, the law dictates that a double liability was also formed. This is dangerous because your business and personal assets can be subject to a claim for a personal or business mistake committed by either you or your business partner. In short, both of you will be jointly and severally liable. Hence, a better way of doing business is to instead set up a limited liability company. This will separate your business assets from your personal assets. So if you make a business financial mistake and someone filed a claim, your personal assets will be protected. Similarly, if you commit a personal financial mistake and someone also filed a claim, your business assets will be protected as well. Therefore, you need to learn how business entities work so you can better protect your assets. Rule number 6. Avoid using cash. In the 1970s, the world transitioned from using the traditional gold standard to fiat money. Instead of having money backed by the gold reserved, the new fiat money is not backed by any commodity at all. Instead, it was put under the control of the central bank. This move also created what is now known as inflation, which entails that as more money is being created, the more it loses value every year. That is why Robert recommends that instead of stacking up cash, make use of assets that appreciate and generate cash flow. And those are some of Robert Kiyosaki's top rules of money. What are your thoughts on this? Do you agree with his take, and do you think this will help you create and build wealth? Let us know in the comment section below. We love to hear from you. And with that, thank you very much for watching. If you like what you've watched, stay tuned for more videos. Bye, financial buddies!